So in the earlier episode, we discussed about what do we mean by amalgamations, absorptions, and external reconstruction. Now we have an accounting standard which is dealing with its accounting. This accounting standard, it is titled as Accounting for Amalgamations. Now if you see in the title, they are using the word only amalgamations. Well, in the earlier episode, we were discussing about amalgamation, absorption, as well as external reconstruction. AS14 does not make any distinction between amalgamations, absorption, and external reconstruction. It considers everything to be one and the same. In other words, the same accounting standard will be applied to amalgamation, absorption, as well as external reconstruction. So it is not something like this that you have to read the entire question. Then you realize that, okay, this is amalgamation, so I will follow AS14. Okay, this is not amalgamation, but absorption. And then you are wondering that if it is an absorption, then how will I do the accounting? So don't worry about that at all. Okay, don't worry about that at all. Whether it is amalgamation, whether it is absorption, whether it is external reconstruction, same accounting standard will apply. AS14 does not distinguish between the three. AS14 considers all the three to be one and the same, and hence it is loosely using this term amalgamation. But AS14 I will apply for amalgamation, absorption, as well as external reconstruction. Okay, so don't worry at all. AS14 will take care of all the three. You may then wonder that if AS14 considers all of them to be the same, then why were we discussing the difference between the three in the first place, isn't it? See, that is necessary. When you read the question, then in some question they will say that prepare balance sheet after amalgamation. Then in some question they will say prepare balance sheet after absorption. In some question they may say prepare balance sheet after external reconstruction. So if you are a student, then this will obviously come to your mind, right? This is something that will always come to your mind. That in some question they are saying amalgamation, some question they are saying absorption, and so on. So that is the reason I have differentiated between the three, so that when you read the question, you can understand, right? You can understand what is the difference between amalgamation, absorption, and external reconstruction. Now, as a student of an accounting standard, you have to also understand that all the three, although technically are different, accounting treatment is the same. See, understand that. I am not saying amalgamation, absorption, external reconstruction are the same. No, they are not same. They are all three different things. But when I sit down for accounting, that accounting treatment will be governed by the same accounting standard. Okay. So AS14 is to be applied. Whatever we will discuss in AS14, that will be applied for all the three. Now, let's take a simple example and understand the next concept that I want to discuss in this particular episode. Let us say there is a company A Limited. Okay, it wants to take over another company which is B Limited. So A Limited will be considered to be a purchasing company, right? While B Limited will be considered to be a selling company. There are other terms also used. You can say this is selling company. You can say this is a transferor company. You can say this is a vendor company. Similarly, this is purchasing company. You can say this is a transferee company. Okay, transferee company. You can even call this as a vendee company. Okay, but the popular words, or I would rather say common words, are purchasing company and selling company. It will be more easier for us to discuss on these lines. The accounting standard uses the word transferor and transferee. Vendor and vendee, that is also quite popular. But when we will be discussing our questions, we will normally refer as purchasing and selling because that will be more easier for us to understand. Now, A wants to take over B Limited. That means we want to buy out B Limited. Technically, this is absorption. Okay. Purchasing company, selling company. In amalgamation, you require two or more selling companies. Here, there is only one selling company. And in amalgamation, purchasing company is a new company. We are considering A as an existing company here. So let's say it is absorption. But as I said earlier, it doesn't matter whether it is absorption, amalgamation, external reconstruction. AS 14 treats everything as the same. Okay, now you want to buy B Limited. A wants to buy B Limited. If you want to buy another company, then you will have to pay for the business of B that you are taking over. I hope you agree with me over here, isn't it? You are not going to buy B Limited free of cost, right? I'm not able to buy B Limited free of cost. I will have to make a payment. So A Limited will have to make a payment to B Limited. This is what is popularly known as purchase consideration. Remember, in questions of amalgamations, the most important working is purchase consideration. Let me make one thing clear. Now onwards, whenever I say amalgamation, it includes absorptions, it includes external reconstruction. Okay, every time I will not use all the three terms. So whenever you are solving any question of amalgamation, this is one working that has to be compulsorily carried out unless and until the purchase consideration is directly given in the question. And let me tell you, in the history of ICAI, it has never given purchase consideration directly in any question ever asked in your exams. Okay, never. It has never happened. So, purchase consideration is what we have to calculate. As I said earlier also, right? A wants to take over B Limited. A wants to take over B Limited. Question is for how much, isn't it? Question is how much. So if B is selling its business to A, naturally B will like to receive payment for the business that it is transferring to A. This payment is what is popularly known as purchase consideration. Basically, it is interpreted from the viewpoint of the purchasing company. We will interpret this as sales consideration. You understand that? Sales consideration. A is buying the business or purchasing the business. B is selling the business. So the money that A will pay to B is purchase consideration. But that same, if I interpret from the viewpoint of B, the selling company, then you can say it's a sales consideration. But sales consideration is not the popular term. Popular term is purchase consideration. So the basic question that arises is, how will I determine purchase consideration? How will I calculate the purchase consideration? Okay, what is purchase consideration? Purchase consideration is payment to shareholders of selling company. Okay, this is the simple meaning of purchase consideration given in accounting standard 14. AS 14 says that whatever you are paying to the shareholders of the selling company is purchase consideration. They have used the word shareholders, so it includes both equity as well as the preference shareholders. So whatever you are paying to equity shareholders, whatever you are paying to preference shareholders, that will be considered to be the purchase consideration. Fine. It is also possible that the selling company does not have any preference shareholders, then fine. Whatever you are paying to equity shareholders, that will become the purchase consideration. Getting it? Yes, it is also very much possible that when A is taking over B Limited, A is paying, okay, A is paying to debenture holders. Just a second, I'll just write it properly. A is paying to debenture holders of selling company. For example, A is taking over B Limited and B has issued debentures. If B has issued debentures, I will have to make payment even to the debenture holders also. Yes, it's also very much possible that A is paying to creditors of selling company. Not only that, when you are doing this amalgamation, you will have to liquidate the selling company. So you will have to pay for the liquidation expenses. That is also possible that purchasing company is paying for liquidation expenses. Remember this thing. None of this forms part of purchase consideration. No, because Purchase consideration is simply the payment that you are making to the shareholders. Okay, remember this thing. Only what you pay to the shareholders is a part of purchase consideration. Are you making payment to the debenture holders? Fine, you will have to make the payment to debenture holders. You will have to settle the creditors also of the selling company. You might be paying for the liquidation expenses, but these are not payments to the shareholders. And because this is not a payment to the shareholder, it will not form part of purchase consideration. These are payments separate of the purchase consideration. So remember the simple rule. Ask yourself, are you paying to equity shareholders of selling company? Yes, part of purchase consideration. Are you paying to the preference shareholders of the selling company? Yes, part of purchase consideration. Any other payment does not form part of the purchase consideration. Right. Next, let us say we have finally decided the purchase consideration. Assume for a moment that purchase consideration is 100 lakhs of rupees, let's say 1 crore. The next question that arises is the settlement of purchase consideration. I'm writing in short, settlement of purchase consideration. A wants to take over B Limited. It is finally decided that we will pay to the equity shareholders and preference shareholders total 100 crores. So 100 crores, 100 lakhs. So that's a part of my purchase consideration. How will I settle the purchase consideration? Think of it. There are different ways in which it can be done. What do you say? You can pay this in cash, isn't it? A wants to take over B. A has a huge amount of cash reserve. It can pay 1 crore to the selling company and settle the purchase consideration. So we can pay in cash. What more? It can also be paid by issue of equity shares, isn't it? It can also be paid by issue of preference shares. Similarly, it can also be paid by issue of debentures, right? There are different ways in which you can settle this purchase consideration. So if I'm having huge amount of cash reserves, I will make payment in cash. Or what I can do is I can issue equity shares. So let's say you issue equity shares to the equity shareholders of the selling company. So whoever is a shareholder of the selling company will then later on become shareholder of the purchasing company. Or you can issue preference shares. Then the shareholders of the selling company will become preference shareholders of the purchasing company. You can even issue debentures as well. Remember, all this you are paying to the shareholders of the selling company. So I can even issue debentures. It's very rare, but then that can also be done. Very rare, but this is also something that can be done. These are the popular ways of settling the purchase consideration. This is not so popular, but it cannot be ruled out. So these are ways in which I can settle the purchase consideration. I can also issue equity shares or preference shares. In both of these cases, you may require a share exchange ratio. See, this is known as a share exchange. Whoever is an equity shareholder of the selling company will surrender its shares and in return or in exchange will get shares of the purchasing company. So you require a share exchange ratio. For example, the selling company has 1 lakh equity shares. Now, if you have 1 lakh equity shares in selling company, that does not mean you will get exactly 1 lakh shares even in the purchasing company. You may get more than 1 lakh shares. You may even get less than 1 lakh shares, depending upon the share exchange ratio. How will the share exchange ratio be calculated? Share exchange ratio will be selected base of selling company. I'm writing in short, selected base of selling company divided by selected base of purchasing company. This is how you can determine the share exchange ratio. Shares of the selling company are to be converted into shares of purchasing company. So this can be the way the share exchange ratio is determined. What do you mean by selected base? Okay, this selected base can be earnings per share, it can be market price per share, it can be intrinsic value per share, okay, or the book value per share. These are the different bases that can be selected. Think in this way. You have A limited, you have B limited. A limited has 1 lakh shares. B limited also has, let's say, 1 lakh shares. The market price per share of A limited is 100. The market price of B limited share is, let us say, 50. Okay. And A wants to take over B limited. Okay. A wants to take over B limited. So A wants to take over B limited, and A wants to issue equity shares to B. And they are saying in ratio of market price per share. So the selected base is the MPS. So share exchange ratio, the way you will get it, the share exchange ratio, as I said, it will be the selected base of selling company divided by selected base of purchasing company. Tell me, which is the selected base here? Market price. So it will be 50 divided by 100. So the share exchange ratio is 0.5. 0.5 means for every one share in the selling company, purchasing company will issue zero point 0.5 share. See, you have 1 lakh shares. The selling company also has 1 lakh shares. Selling company has 1 lakh shares does not mean I will give exactly 1 lakh shares to them. Please understand. The share price is only 50 here, while my 1 lakh shares are worth 100 rupees. Purchasing company shares are more valuable. Then why will I give more number of shares to the selling company? So what I will do is I will give them zero point 0.5 shares. So how many shares are there in B Limited? 1 lakh shares are there. You will multiply this with zero point 0.5. So you will get 50,000 shares. Okay. This 1 lakh is shares of B Limited, while this 50,000 is shares of A Limited. Fine. 1 lakh shares are of B, they will get converted into shares of A Limited. So if you are a shareholder of B Limited, you will surrender your shares in favor of A and become a shareholder of A. And in your place, A Limited will become a shareholder in B Limited. And that is how you will start controlling B Limited. But what if the market price per share of B Limited is 150? Then see, things will change now. This time it will be 150 divided by 100. So it will turn out to be 1.5. Value of one share of the selling company is higher than that of the purchasing company. So now the purchasing company will give them more number of shares. So that is how a share exchange ratio can be determined, and you can settle the purchase consideration.